Drenad Trust here. Based on recent analyses and technical indicators, there are signals suggesting heightened volatility in the stock market, potentially leading to a correction or even a crash, right? Though basically a definitive crash is uncertain to some sources. Multiple sources and expert insights point to increasing signs of market stress with some forecasting a significant correction. Now, there are some, indicators, right? We have chart-based signals. So a prominent technical, analyst warns of a significant decline around 10 to 11% based on chart patterns, trend lines, and Elliott wave theory indicating the recent market top and basically a likely pullback. There's also some trend line resistance. So resistance levels on major indices hint at rejection and possible downtrends if key support levels are broken, which could accelerate bearish moves. Now, in regards to broad market conditions, valuations, and sentiment, the S&P 500's high valuation at around 22x forward earnings coupled with rising treasury yields suggests risk of a correction if earnings fail to meet expectations or if bond yields, continue to rise. Now, factors such as elevated global debt in regards to economic risks, right, restrictive monetary policies, and tariff uncertainties are increasing the vulnerability of equity markets, raising the likelihood of a correction or crash. Now, in this video, I'm going to go over stocks with the largest portfolio loss, right, in this potential upcoming stock market crash, better strategies than panicking or hard selling, right? And how to avoid high margin debt risk during a stock market crash. So let's go over, like loss of portfolio value. So investors worry, they typically worry about sharp declines in the value of their stocks, retirement accounts, and other financial assets, basically leading to feelings of lower net worth and reduced financial security. Now, some of the stocks that can make that somewhat of a possibility based on the numbers is NVIDIA. So NVIDIA saw a rapid 17% drop due to concerns over the Chinese AI competition and vulnerability from inflated valuations. Advanced Micro Devices, AMD, fell by about 8% after AI/data center chip sales disappointed, compounding negative sentiment in the semiconductor sector. We have, IonQ, plummeted around 40% after quantum enthusiasm waned and leading figures cast doubt on short-term adoption. We have Broadcom, AVGO, and Marvell, which lost 7 to 9% as the AI-driven rout affected major semiconductor names. We have Tesla, which dropped 5% amid renewed tariff concerns and squeezed profit margins from price cuts. Edison International, which basically sank a shocking 32% after wildfire fears exposed litigation risks and rattled confidence in utilities. PG&E, also known as PCG, right, lost 22%, caught in the wake of the California wildfire risks and memories of bankruptcy. We have Moderna, which declined 17% in one day as a lower vaccine sales led to drastic cost-cutting guidance. Next we have is Super Microcomputer, SMCI, UiPath, and Sound AI, which experienced double-digit dips due to overvaluation and sentiment reversals in AI-related stocks. Now, don't panic or hard sell, right? Rapid sell-offs fueled by fear and panic can trigger domino effects, accelerating market declines and making investors anxious about timing their exits and entries. So here are better strategies, right? You want to have a defensive assets and cash reserves. So during market downturns, you want to shift your focus toward defensive assets such as healthcare, stocks, utilities, consumer staples, gold, and government bonds, which typically retain value even when markets fall. You want to hold ample cash reserves, right? Basically allows you to avoid forced selling and positions you to buy quality assets at discounted prices where recovery begins. Also there is the rebalancing and diversification strategy. So regular portfolio rebalancing prevents overexposure to risky sectors and assures that gains are locked in and reinvested in safer categories. Diversification across stocks, bonds, and other assets buffers your investments against severe losses in any single category. So diversify, diversify, diversify. You want to have a disciplined risk management. You want to set clear stop loss and take profit parameters to reduce emotional decision making. In regards to position, right? You want to position the sizing and technical alerts that can automate parts of your strategy so that decisions are rules based rather than reactions to headlines or fear. You want to have long-term perspective and patience, right? Resist panic selling and speculative trading based on temporary price moves. Historically, okay? Historically, markets recover from crashes, and staying invested or using dollar cost averaging can outperform market timing for most investors. Now, one of the kings of investing, Warren Buffett's advice is to focus on the long-term value of your investments and ignore short-term noise, reinforcing that market crashes are opportunities to buy great companies at lower prices. So, hey, that's the guy, Warren Buffett, right? Who can really argue with that guy? Now, in regards to debt and margin risk, right? High levels of margin debt and leverage positions become especially risky in a crash, increasing the threat of margin calls and forced liquidations, which can magnify losses. So, basically, the best approach is avoidance. Now, to avoid high margin debt risk during a stock market crash, it is crucial to manage leverage carefully and employ risk mitigation strategies. You want to limit or avoid borrowing on margin altogether to reduce exposure to forced selling during market downturns. Now, margin debt amplifies losses and can trigger margin calls, forcing investors to liquidate positions at unfavorable prices. So you want to keep that in mind. So, can't stress this enough. You want to diversify your portfolio to avoid concentrated risk that could increase margin calls and losses. So diversification, it's the solution for many things. So you want to use trend following or moving average strategies to time market entry and exit based on margin debt levels and price trends, reducing exposure when margin debt is high compared to moving averages that can lower risk. You want to maintain a sufficient cash buffer and avoid over leveraging as a minimum equity maintenance margin requirement, right? That's typically around 25 to 30%. So, that must be meant to avoid margin calls. So you want to regularly monitor your margin debt relative to your portfolio value and the overall market to anticipate the vulnerabilities. You want to consider shifting to safer assets such as cash or short-term bonds when margin debt levels are elevated or market volatility spikes. Okay, you want to keep that in mind. Now, economic recession concerns at a broader, perspective, right? Broader recession, job losses, shrinking corporate profits often arise as declining consumer and business spending impacts overall economic growth and stability. Now, inflation and interest rates, elevated inflation and rising interest rates erode purchasing power and squeeze corporate profits, fueling market, pessimism and reduce investor enthusiasm. Now, overvaluation and speculative bubbles, right? Skepticism, basically about high valuations, such as in the tech sector and AI sector, and the bursting of speculative bubbles are prevalent worries, right? With it, basically investors questioning sustainability and long-term prospects. So, in regard, you want to look at the sequence of return risks, right? For those who are close to or in retirement, right? Drawing income during downturns can exacerbate losses, making asset allocation and withdrawal strategies top priorities, right? For the people who are on the cusp of retirees, you want to make sure that those are addressed. So that's what I have for today. Please take a moment right now to hit that subscribe button and the like button. I appreciate viewership. Stay safe. See you on the next video.